Hi, my name is Evy Hambro. I'm the manager of the BlackRock World Gold and World Mining Funds, and it's a great pleasure to be here today.
大家好，我是今天的主持人 Paul。今天国泰世华非常开心，邀请到贝莱德世界矿业基金及贝莱德世界黄金基金的经理人韩爱菲 Evy Hambro， 针对全球矿业为各位带来第一手的即时观点与分析。
Yes, so my family has been in banking for many generations, and banking obviously involves money and gold and trading of commodities. So I've always wanted, since growing up, speaking to my parents and so on around the dining room table, Sunday lunch, those kind of things, and learning about markets. So to me, this has always been an area of interest. When I was at university, I applied to do internships with banks and fund management companies. So it's something that I've always wanted to do, and I've been lucky enough to be able to do it for the last 32 years. There's a number of ways to answer that question. I'd say the first thing to think about is we don't try to forecast the price of gold in the short term, because the main reason is that nobody ever gets it right. And so why would we waste our precious time researching something that we know we're not going to get right? What we try to do is to forecast the direction that a commodity price will go in. And if we can get that direction correct, then we can build a portfolio of companies to capture the performance from that commodity price. So that's our main aim in terms of what we do. In terms of what's driving the price of gold, I think that's a much bigger question. And we're often asked, is this the right price? Should it be lower? Should it be higher? What's going to happen next? I think in order to be able to understand that, you need to know why it is where it is. And right now, we think the single biggest driver of where the price of gold has reached is to do with governments and the problems that governments have. Most governments have been spending too much money. They are spending on many things, whether it's social payments, whether it's spending on infrastructure, and more recently, especially in the West, it's on defense. And this is a huge financial burden for governments. In many cases, they are having to borrow to be able to fund their outgoings. And so their balance sheet is expanding. And that means they are issuing more bonds, issuing more paper money. And as a result of that, the purchasing power of paper currency continues to decline. What we've seen over the last, 75 years is the speed of expansion of government balance sheets has accelerated. And so the problem, as we call it, continues to get bigger. As it gets bigger, faster, then things respond to that. And the price of gold is one of the things that has responded to that. The cryptocurrencies have responded to that. Equity markets have responded to that. Real asset prices, property, have all responded to that. And they have preserved their value through time. Paper currency has lost its value through time. And so gold, to me, is responding to this trend. And therefore, in trying to answer your question as to where gold is likely to go to next, I remember when gold was trading at $252 an ounce in 1999. And I ended up going to an event in Shanghai. And I was asked if gold could ever get to $1,000 an ounce. And I said, yes, of course it could get to $1,000 an ounce. And I came back to London and I met one of my colleagues in London. And he said, that was a ridiculous thing to say. You should never say something like that. And I said, well, why not? Gold, it's not about the price of gold. It's about what's causing the price to change. And if the reason why the price is going to change is getting bigger, faster, then gold is going to respond to that. And here we are today with gold prices at $4,000 an ounce. Well, there's lots of questions there. I'd say the first thing is that the price of gold today is allowing mining companies, gold mining companies, to make good profits. The margins have expanded as the price has gone up. At some points in the past, the price has risen, but the cost of producing has risen as fast, or in some years, even faster than the price has gone up, and margins did not expand. So what we're seeing today is huge margin expansion, a massive increase in profitability, and gold mining company share prices have responded to that. The question, therefore, is, are they reflecting that in their share prices? What gold mining companies today are reflecting is prices to fall. Yeah? If you look at the research in financial markets, the average price that people are using 3 or 4 years into the future is about $2,800 an ounce. That's the price that the market is using to value the equities. If the price is higher than that, then the equities look very, very cheap. If you go into the derivatives market and you look at the future price of gold, it's over $5,000 an ounce. There's a very, very big gap between what one part of the market is using and what the future price is likely to be. If the $5,000 an ounce price is correct, then gold shares look incredibly cheap. If the price stays where it is today, then they look very, very cheap. And if it was to retreat back to where the market is expecting, then they would be fair value. So to me, I think there's an enormous opportunity in the gold market right now, which is underpriced in gold shares. You asked about the relationship between gold and cryptocurrencies. That is a question that we are often asked. When I think about cryptocurrencies, what are they doing? They are reflecting a view, like I mentioned earlier on, that there is a problem amongst governments and that paper currencies are being devalued, and they are responding to that. If you think about Bitcoin has limited supply, and therefore it is likely to reflect that relative to the ever-growing supply of money and bonds issued by governments. And so the idea is that as that price goes up, it is responding to the expansion of government balance sheets. Gold has very, very similar characteristics, but that is where the relationship stops. Gold has been a source of diversification, a means of exchange for thousands of years. It is trusted by everybody, and crypto is new. I think it will take time. Also, crypto is much more volatile than gold. So I think that there is a role for both, but I wouldn't say one is necessarily better than the other. Yeah, so I think we are at a very interesting point geopolitically right now, where we are seeing a big difference between how governments view the importance of the supply of commodities, principally industrial metals, versus how investors think about them. Governments have realized that the direction of travel for the global economy is going to be much more industrial metal intensive. We need these commodities for the building of data centers. We need these commodities for the rebuilding of the electricity grid. We need uranium for nuclear power. We need copper. We need all rare earths. We need all of these commodities for the way that the global economy is going. The mining industry has not been investing enough into supply because prices have been too low, and there hasn't been a financial reason, a positive financial reason, to build new capacity. And so supply has been fairly static or not growing very much for many, many years. And now we are seeing a huge change in demand coming up with the enormous scale of investment that's taking place into AI and data centers and the grid and the renewable power sector and so on. The challenge on all of that investment is generating enough power to be able to feed the things that are going to consume it. And governments understand this. And so they are very focused on accessing the commodities that they need, the critical minerals and so on, for this next phase of economic development. And so what we're seeing geopolitically is the kind of weaponization of supply chain of materials. And that is happening at levels way above me. I can't comment on those things. But what I do see is how irrelevant commodity producers are in financial markets. the value of all of the commodity companies is tiny. It's, with the value of the market cap of one of the big hyperscalers changes in a daily basis more than the value of the whole mining sector. And it just shows you how irrelevant the valuation is compared to how relevant these companies are with regards to the global economy. To me, that is an enormous arbitrage opportunity. Governments have identified it. Financial investors have not yet identified it, because if they had, they would be paying more for these shares. And so to me, I see the growth, I see the profitability, I see the way that the companies are run, and I see the opportunity set for revaluation of these businesses. Yeah, so the uranium market has been going through a renaissance in the last few years. And the reason for that is that a lot of the consumption of power requires it to be clean, reliable, and low cost. And you cannot solve for that using fossil fuels. It's very difficult on a cost base for it to use other sources. And renewable power is intermittent. When the sun is not shining and the wind is not blowing, there is no power. And so there has to be a solution that meets the needs of the consumer. And so we're seeing people turn to nuclear in a very, very rapid way. However, the growth in the generation of nuclear power is going to be long dated. You cannot build a nuclear reactor in the next month. It will take many years for this expansion to happen. But we are seeing big commitments being made by governments around the world to grow capacity, because they understand how much more power is going to be needed in the future. In the short term, the growth in demand for power will be met by supply from renewables and from gas. Those will be the two main sources that will meet that. And then in the medium to long term, it will be nuclear. So what does this mean for the price of uranium, which is your question? It means that the demand is going to go up and the market will be rejuvenated in terms of profitability for uranium companies, which we have exposure to in our portfolios. But please remember that this growth in demand will happen far into the future. It won't be in the next 6 months or 12 months. It will be as the capacity, the nuclear generation capacity, is added, and that will take several years to arrive. The copper market is absolutely fascinating. We have been positive on the outlook for copper for many, many years, and probably for longer than we should have done. We were probably a little bit too early into the copper market, but it is now starting to play out. The price of copper has traded above $5 a pound. It used to be less than $3. People would dream of a price of $3. When I started my job, it was 60 cents a pound. So it's nearly up. It's up 9 times in price over 30 years. And so the market is going in the direction that we expected it to do so. What's fascinating, though, on the copper market in terms of supply and demand, on the demand side, copper demand growth globally has been around 2% per annum for most of the last 20, 30 years. There have been periods where it's more than that, much more than that, and periods when it's that, but that's the kind of average that it's been going at. The growth that we have been talking about in terms of increased demand for electricity is likely to see demand growth for copper increase by 1 or 2% more per annum than it has done historically. Now, that might not sound like very much, but when you think about that, each 1% is around 300,000 tons a year of copper. Yeah, that's a lot of copper. One of the world's biggest mines produces 300,000 tons a year of copper. That would be a top 10 mining project. And they take a decade to build and get up to full capacity. So the response on the supply side is very, very long dated, whereas the demand growth is happening shorter than that. So there is a gap between supply and demand. And as that gap gets bigger, the price is likely to respond positively to that. In addition, the existing mines are struggling to produce at full capacity. I always like to think about the copper market, trying to make it relate to things that people understand. So OPEC in oil supplies around 10% of world production. And when OPEC makes an announcement and they want to add supply or reduce supply, the price of oil reacts. OPEC produces about the same amount as Peru produces in copper. Chile produces twice as much as OPEC produces in copper versus oil. So what happens in Chile and Peru is really, really important to the copper market. People don't pay any attention to that. And when you look at some of the problems that these mines are having in those countries, access to water, environmental issues, power, people, it's been very difficult to be able to grow production, especially in Chile, the world's largest producer, because of the structure of the industry in Chile, with it being mostly state-owned for the largest producer. So the point I'm making is that the supply side is likely to grow slower than the demand side. As the demand side grows faster, that will put pressure on prices, and companies will enjoy better pricing and higher profitability, which is why we have a lot of exposure to copper in our portfolios.
最后，再次感谢各位今天的收看。未来国泰世华也将持续与您分享最新的投资趋势与观点。我们下次见喽，拜拜。
投资一定有风险，基金投资有赚有赔，申购前应详阅投资人须知或公开说明书。